Good morning, Alan, or I should say good afternoon, Alan. It's Friday, the 19th of February. It'll be just me and you today. Let's do our Friday investment talk. Let's start with you because I know you want to talk about semiconductors and you want to talk about healthcare, some of the big themes we've been talking about previously. So we'll just jump into that.
Certainly interesting from a political and economic standpoint. Is the coming or the present shortage in semiconductor. That's basically perfect storm of supply and demand problems. So, there's much more electronic semiconductors being required into cars, especially electric vehicles, for example. But obviously, as more people are staying at home, the demand for gadgets and laptops and various other things has increased hugely. So that's one of the things. There's also been a bit of a squeeze on rare earth metals. A letter from the Semiconductor Industry Association, which is mostly a US-based industry body, and they wrote a letter to the Biden administration, basically saying bring home semiconductor production. Which is kind of ironic considering the guys that wrote it are the semiconductor producers. But what they were saying is they want the Biden administration to oil the wheels, basically help that happen, help facilitate that. Because you've got companies like Micron and Intel, they're in Ireland, they're in Israel, they're in various other countries as well as China is the obvious one. And they basically said that, and I quote, it can reinvigorate the US economy, job creation, strengthen national security, and semiconductor supply chains, and ensure the US remains the leader in the game-changing technologies of today and tomorrow. I mean, it's pretty strong language.
Yeah, to consider this a national security, and it is in the sense
exactly,
that, like, if China gets these small chips
right.
that can produce,
that's where the interesting geopolitics comes in. Yeah. So it's not just about making chips. And obviously there's what we didn't mention there is Taiwan, which right. that's the hot spot between China and, let's say, the US or even the West, if you want to put it in basic terms. So which you're going to have potentially a flashpoint there. I think it's only a matter of time before there is a flashpoint. It could be 10 years from now, but it's definitely going to be something happening there. So we had I don't know if you want to look at SOX, which is basically the broad index for semiconductors, and then we'll look at a few specific ones. There's definitely going to be a supply issue probably for most of this year, because new factories are getting produced. We'll come on to that in a second. New factories are coming online, expanding current factories capacity. But that won't really impact until the end of this year. So, if demand continues to stay where it is, then we're going to definitely see some movement, I think, in stocks.
And Alan, as we were saying privately, this is not necessarily about the big manufacturers like Intel, AMD, and these, but there's other more interesting names that are specifically devoted to certain types of applications. It might not be the best way to play this in this SOX index because this is heavily weighted by big chip producers like Intel and AMD, whereas you want to be maybe allocated to some better names that are specific for driverless cars and space technology.
Well, we looked at a couple that we talked about earlier. Chris, was ACMR, I think, ACM Research, which is basically they produce prefabricated factories which can be turned into manufacturing facilities for semiconductor chips.
So as I mentioned on our blog, and then I mentioned Analog Devices here. Arista Networks came out last night with great earnings, and I said probably this will end up retreating after earnings because that's how things are doing, right? So look at it now; it's actually only up 1.4%, and it was up at one time over 10% last night. So these are interesting buying opportunities in the market right now for some of these semiconductors, for sure.
Do you see weakness? I mean, you're saying there's buying opportunities. I mean, we're going to talk about market weakness in general that we're in the middle of or just starting maybe the cusp of. Do you think these are kind of protecting a little bit on the downside?
The results are amazing when they come up with their results and they say, they beat expectations by 20-30% on their earnings. Well, yeah, that's great, but the stocks aren't performing well. They're not responding to that. Investors aren't responding to that they wait a couple of days and then respond to it. And that's what we've seen is, usually after these companies present earnings, the stocks pull back. And then some people buy either long-term call options or they get back in the stock. And we highlight those, like ADI pulled back after its earnings, and immediately people were started buying calls in it yesterday, long-term calls, and now it's up about 3% today. So yeah, any dips, anytime that these great companies come up with earnings and are not being rewarded for that is a great time to buy. And so we've tried to highlight that on this blog, and there's quite a few companies we've come through. ACMR was one of them, but there's a lot of stuff on here that subscribers can get access to. There was over 20 stocks I mentioned in this commentary at one time. So some of these stocks are interesting and offering buying opportunities now, but one of the things we need to watch out for is seasonality. And we published and showed this back in January 22nd about how the second half of February could be weak, right? And we saw a little bit of that this week. The last 3 days, we had 3 negative days in the market, which is kind of a strange thing to have in the middle of a bull market, is 3 down days. Next week can be usually, it says here, the end of February is challenging in recent years. So they highlight that on the Stock Trader's Almanac on certain pages, which we're headed into next week. And then I wanted to bring up March seasonality is a strange thing where the weather comes in like a lion and goes out like a lamb. It's the exact opposite for the stock market. You're in a bullish period still through, say, May, but this is not a good performing month, especially in post-election years. So we have the March calendar here. It's clustered with bullish little faces in the beginning, but then in the end, it's kind of blank, and you see a couple bear faces in the calendar. So we have to be careful so that next week's volatility leads to a little bit of a rebound in the market, but after the Ides of March, we could be seeing a pullback. So one of the things I put on here for subscribers is to listen to a small video. It's 23 minutes from the editor and the son of the founder of the Stock Trader's Almanac. So Jeff Hirsch is on here, a really good video. I'm going to talk about, Alan, real quick interest rates, which is
I think it's just huge news and it's a warning sign for all investors, I think.
Right. So one of the things we've been watching closely, kind of poo-pooing all this money is going to create inflation, and we were more like, no, it's not going to create inflation, at least not yet. We haven't seen it. Well, now I'm telling you, we're seeing it. So the PPI came out with bad numbers, and I highlighted that in the U.S. Trade Talk Telegram channel. Right. So I'm just going to run through the headlines as I see it. Okay. So first of all, we see PMIs, in other words, industrial manufacturing going up, but the service sector is lagging. You could see that in the German numbers that came out this morning. We have PPI up, in other words, producer price index is up, but the consumer price index are not. And so PPI was up. If you stripped away some of the non-essentials, it was up almost at a 2% growth rate per year, which is the Fed's target for 2 years from now. So this is worrying. This is concerning. We see commodities up, and I can bring up commodities. Some of these DBC, basic commodity index, up 20%. You even have agriculturals up. These are making big moves here. So these are basically just aggregate, poorly designed ETFs that track commodity indexes, and even they're able to move between 12 and 20% in 2 to 3 months. So these are big moves in commodity prices. This puts pressure on the PPI, and this is going to affect the ability of the Fed to continue to hold interest rates low. So what does that mean for everything? Well, one thing I want to highlight, and it's really interesting, is gold. Well, your inflation hedge is usually gold. Gold is not responding to this. What is responding to this? Our friend Bitcoin. Bitcoin is up to what, $57,000 today or something now? I mean, like, this is incredible. The run is
it's over $1 trillion market cap for the first
time. So again, I'm going to just rehash. PPIs are up, CPIs are lagging, Bitcoin is up, gold is lagging, and commodities are up, while stocks are likely to start flagging here. And that's kind of the message I wanted to get across real quick here. The headlines about interest rates, I'm going to just bring up from the Financial Times and the Wall Street Journal, you can read, U.S. bonds are selling off, and that provides a lead into the fact that the stock market strength may be weakening in the future also. And then where's money going in the bond market? Well, it's going to these junk bonds, which every company is able to restructure their debt. Even companies like, what was it? Not GameStop, but one of those companies that got bid up in the short selling, right?
ACM or something like that?
AMC, right? The movie theater, right? AMC, the movie theater group was able to issue tons of bonds and pay off their debt at really low interest rates, right?
So it's convertible bond. I think $600 million convertible bond.
Under 3%. When there's free money, this is what happens. Yeah. So you see, investment grade bonds are not attracting interest because they don't pay any, they don't have any yield, and all the money is going into the high yield bonds. What we've seen recently is the tick up in the 30-year treasuries. A tick up to where they pay more than 2%, or the interest rate on them is more than 2% for the first time since the pandemic. What does that lead to? That leads to a bond sell-off in the long-term bonds. And that really has kicked up in in February, the last 2 weeks. The TLT of the long bonds are down almost 7%, which is huge for a bond market to move, right? So this is based entirely on the fact that interest rates are moving higher. So TNX is your treasury yields, and this is going from 0.6% all the way up to 1.4% now. So you can see these are 10-year treasuries. This is inflation expectations. This is how the market responds to the fact that PPIs are going up, and that likely the Fed will not be able to lower interest rates and long-term bonds going out further. So I just wanted to highlight that. That's a pretty big play. That's something we have to watch, because that could be headwinds to the market. One of the things you can see, if you watch this video, one of the graphs Jeff presents at the end is this graph long term of what happens, and I don't know if you guys can all see it, but what happens when basically CPIs, inflation happens. So when it starts really ramping up, markets go sideways, markets go sideways, markets go sideways. And so that's maybe what we have to watch here. We've had this docile inflation since the mid 80s, really lame, really predictable. Central banks have been really good at controlling inflation. The important thing here is if we see consumer price index to increase, which is usually going to happen if the PPIs start increasing.
It's inevitable, really. Yeah.
It's almost inevitable, yeah. You're going to see the market flatten out for maybe even a decade, which is quite an interesting phenomenon when we've experienced such robust growth in the last 12 to 15 years. So I just wanted to highlight that stuff we're watching, but the trades are there, and we can keep them.
I think it's important to not be all doom and gloom. I mean, the 2% target is hardly hyperinflation, and it's the target that the central banks are kind of aiming for. And given the amount of money that they've flushed into the system, it would be unlikely to not see some kind of a response from inflationary sources, really, because money is going somewhere.
Yeah, absolutely. The Federal Reserve, they want inflation. Central banks want some inflation, but they want to be able to control it. What they don't want is for it to start getting out of control.
Right.
And you have to wonder, with all these stimulus package, how much of this actually gets trickled down to actual consumers and isn't just used for funding crazy projects, because your company can go to the markets and get more debt easily. And that's, I think, what we've seen with a lot of these SPACs and all this crazy blank check companies. There is some definite froth out there for sure.
Yeah.
Okay. Yeah. Alan, what do you want to talk about now?
I mean, you've got a couple of graphs. I don't know. It was a Guggenheim asset management presentation that was on healthcare. It's kind of one of my favorite topics, my pet topics. I know it's one of yours as well. I mean, we've talked about this in the past with things like ARC genomics and these kind of things. There's a lot of different ways you can play it. We've talked about ARC genomics and various other ways that you can play DNA sequencing and all this kind of stuff. gene therapy, which it mentions there. But there's lots of different other ways to play it, which these kind of list. I think these are different ways that and different groups of companies you can take advantage of. Targeted oncology, diagnostics, personal health monitoring. I mean, basically general wellness, autoimmune and neurological disorders. Those are all different ways that you can play it. They all have different companies that specialize in those areas. This presentation gave us heaps of data about that. I mean, what's behind this? There's 5 or 6. I didn't want to bring up the graphs for these because everyone's seen those graphs before. Graying of the population, basically in almost the entire world, especially in many Western European and North American countries or advanced economies, let's say. Older people are going to be predominant age group in the next 20 years compared to the youth. Older people spend a lot more money. They've accumulated money over their lifetime. They spend a lot more than young people. It's self-evident. There's increased funding from governments. There's an easing regulatory environment and venture capital funding and IPOs, which is really what we're interested in. This has been a major source of capital, which is itself then feeding into these research R&D companies to basically drive these huge advances in medical treatment and medical equipment forward. So really the two graphs I had were basically the why healthcare summary and the previous one that we looked at. The summary, basically, you can see this. Changing demographics are driving demand for healthcare goods and services. Approvals of drugs and devices are increasing, partly because of the deregulation, but it's also just there's lots more opportunities for people to take advantage of producing things that make us live longer and live better. So there's ways to create value. Market performance has been attractive. We've talked about ARC and how it's just triple figure returns so far in their genomics ETF that we like. Basically, we still think healthcare. There is some great healthcare. It doesn't need to be ETFs. It doesn't need to be ARC. There's some great. Guggenheim have a very good healthcare fund. Framlington Healthcare was a long-standing great one. I think that's now owned by Invesco. There's just lots of opportunities around, whether it's regular savings plans or getting into lump sum investments. There's just a lot of opportunities that we like.
I mean, there's two things we focus on, say in our research is the healthcare stocks or med tech stocks specifically. We've mentioned Teladoc, Tandem Diabetes,
Medtronic.
We've mentioned lung, pulmonary stuff. We've mentioned a ton of stuff on kidney disease, RNLX. I mean, we can go through. These are off the top of my head. Here's one we mentioned before it broke out. I mean, a lot of stocks that we pick up on. There's a lot of good research we have access to, whether it's through Stifel, like you showed for the semiconductors, or Needham, or all kinds of little investment banks that specialize in this stuff. And we try to pick up on it before investors really get word of it, and really some of the stuff just takes off. I think, so there's tons of this information out there. And I think, we do a pretty good job of covering some of this, but it's a really interesting sector for me and Alan, and it's really paid off. I mean, this has really paid off.
And as I said, there's a couple of ways to play. You can just buy the index, you can buy ARC. As one way, or you can go into the individual stock.
Markets need to do well for this stuff to work, though. So if we do get a pullback, we have to be careful. This stuff will be the first to hit the fan. So we need to be careful with this stuff. But there's a lot of interesting names out there. All right, Alan, I think I got everything I wanted covered. Have a good night, everybody. Thank you for joining us. And take care, Alan. Bye-bye.
We look forward to next week. We may have some special guests next week.
Okay.
Speak to you later. Have a great weekend.